All right, let's dive straight into this explainer where we're putting the Pennant Group through an absolute gauntlet. We're talking about the greatest investing minds in history. We're going to act as an expert investment analyst today. Take the raw financial data of this company and stress test it against the strict philosophies of some true Wall Street legends to see if it's actually worth your hard-earned money. Here is our roadmap. We'll kick things off with a company snapshot, then evaluate PNTG through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, before looking at some discounted cash flow models and delivering our final verdict. Part 1. Company Snapshot. Rapid growth in healthcare facilities. So, what exactly are we looking at here? Well, the Pennant Group, ticker symbol PNTG, is this rapidly expanding healthcare company operating across 13 states. They handle home health, hospice, and senior living. And get this, they just posted a massive 36% revenue jump in the first quarter of 2026, pulling in $285.4 million with an adjusted earnings per share of 32 cents. The stock is currently sitting at $39.32, which gives it a market cap of about $1.4 billion. Part 2, the Buffett lens, seeking the economic moat and consistent earnings. Imagine we're sitting in a room with Warren Buffett. You know what he wants, right? A truly great business with a deep economic moat, stellar management, consistent earnings, and manageable debt. And honestly, PNTG passes this qualitative test. They're basically digging their moat through some incredibly strategic acquisitions, including over 50 locations they just grabbed from United Health and Amedisys. Their earnings are also super consistent. Net income basically doubled, going from $13.3 million in 2023 to $29.5 million in 2025. Plus, their debt-to-equity ratio is a highly manageable 0.3. Now, the only real knock here is the return on equity. It's sitting around 7.9% on their $374 million in equity. That's a bit below Buffett's ideal 15%, but you really can't deny that overall growth trajectory. Of course, Buffett also heavily zeroes in on owner earnings. That's the true spendable cash flow available to shareholders after keeping the lights on. If we assume owner earnings mirror their trailing 5% free cash flow to revenue metric on roughly $1 billion in sales over the last 12 months, Buffett would see a really healthy cash engine pumping out about $50 million. But as we all know, the Oracle of Omaha demands a strict margin of safety. With a $1.4 billion valuation, he'd probably sit on his hands and wait for a price drop closer to $30 a share before pulling the trigger. Part 3. The Lynch lens. Categorizing the growth story. Now it's Peter Lynch's turn. Lynch loves a company with a strong, easy-to-understand narrative. He'd take one look at PNTG and immediately classify it as a fast grower. I mean, with trailing 12-month revenue growth soaring at nearly 37%, it fits his favorite category perfectly. But we have to look at the valuation hurdle. Lynch's go-to metric is the PEG ratio, where you divide the price-to-earnings ratio by the growth rate. PNTG has a forward PE of 28.5, and if we use projected earnings growth around 18%, we get a PEG ratio of roughly 1.58. Sure, that's a bit above his perfect target of 1.0, but that explosive top-line revenue growth makes it incredibly hard to ignore. He'd also take a quick peek at the balance sheet and be pretty thrilled to see only $5 million in current maturities stacked up against $150 million revolving credit facility. That's a bulletproof balance sheet to fund even more expansion. So, riding the massive, unstoppable megatrend of an aging demographic, Lynch would probably rate this a cautious buy, or at least a hold. Part 4. The Graham lens. The strict value quant. All right, but what happens when P&D faces Benjamin Graham, the famously rigid father of value investing? Graham is a pure numbers guy. He wants a massive margin of safety, and he has a strict defensive checklist. Now, P&D passes his adequate size and debt hurdles easily, but it spectacularly fails his checklist on dividends and valuation. Graham wants a moderate PE ratio, usually under 15. Well, P&D is trading at a staggering 45.5 times its trailing earnings, and it pays absolutely zero dividends. So for Graham, that's a huge red flag. Let's actually run his famous intrinsic value formula to see just how far off it is. We're building this step by step, directly from the raw data in their 10K filings. Graham's formula multiplies a base factor of 22.5 by the earnings per share and the book value per share, and then you take the square root of that whole shebang. So, using their full year 2025 basic EPS of 86 cents and a calculated book value of roughly $10 per share, we get an intrinsic value of just $13.91. With the stock currently trading at $39.32, Graham wouldn't touch this stock with a 10-foot pole. He'd demand a massive, massive pullback before ever considering it safe. It's a pretty brutal reality check for high-growth stocks, isn't it? Part 5, DCF and Alternative Models. What does the math say today? Okay, let's leave the legends behind for a second and just ask a modern analyst. What does a purely clinical discounted cash flow model tell us? To build this, we forecasted their free cash flows. Since they didn't explicitly project this in the filings, we assumed an industry average weighted average cost of capital, or WACC, which is basically the minimum return investors demand, at 9%. We set a base free cash flow of $50 million, modeling short-term growth at 13.9%. When we run the sensitivities, a 9% WACC combined with a conservative 3% terminal growth rate spits out a fair value of $31.40. That is generally below the current trading price, which tells us the stock might be slightly overvalued purely on a mathematical cash flow basis. But let's apply one more model. Let's compare PNTG directly to its peers, like Ensign, Addus, and Shemed. Now this is fascinating. PNTG has nearly double the revenue growth of Ensign or Addus, clocking in at an incredible 36.8% compared to their roughly 19%. That beautifully explains why the market is totally fine giving it such a premium PE ratio of 45.5. And get this, its price-to-sales ratio of 1.3 is actually cheaper than Ensign's 1.8. So when you look at it relative to its raw growth rate, it's actually priced quite competitively within its own peer group. Part 6, Synthesis and Final Verdict. Bringing the gauntlet together. So after running the gauntlet of Buffett, Lynch, Graham, DCF models, and comparables, what's our final investment verdict on the Pennant Group? Blending all these insights, we're seeing a really distinct tug-of-war. The strict value frameworks, Graham and the DCF model, are practically screaming that it's overpriced right now, pointing to fair values somewhere in the teens to low 30s. However, the growth frameworks, like the Lynch lens and peer comparables, absolutely justify the current momentum and that $39 price tag, simply because the top-line revenue expansion is just so extraordinary. Ultimately, PNTG is a hold for strict value investors who just cannot stomach a high PE ratio, a total lack of Graham's margin of safety, or the looming risk of a 1.3% Medicare reimbursement cut. But it's a cautious buy for growth investors willing to bet that management can successfully integrate those 50 new Southeastern operations and keep scaling this incredibly low-debt business. It really leaves us with one final provocative question for you to consider before adding this fast grower to your own portfolio. Growth always comes at a premium, but does a 36% revenue jump justify completely ignoring Benjamin Graham's safety net? You'll have to take a hard look at your own risk tolerance to answer that one. Thanks for joining me on this explainer, and keep learning.